For years, the global economy has appeared resilient, and this narrative continues to be reinforced by headline economic statistics and record-setting achievements across financial markets. Stock market indices have reached unprecedented highs, driven significantly by concentrated gains in artificial intelligence-related stocks and mega-cap technology companies that now represent more than half the market value of the entire S&P 500 index. Technology companies and their investors have placed trillion-dollar bets on artificial intelligence transforming the global economy, and these massive capital expenditures have become the primary driver of economic growth in the United States, accounting for more than 1% of GDP growth in the first half of 2025, and surpassing consumer spending as the locomotive of expansion. Unemployment has remained relatively low in many developed economies, and the financial system has not experienced the kind of catastrophic failure that characterized previous crises. Yet beneath this superficially reassuring surface, a more complex and fragile reality exists that reveals itself when one examines the actual mechanisms of the financial system and the behavior of debt markets, rather than relying on headline statistics alone. Economists, investors, and serious policymakers continue to ask questions that become increasingly difficult to avoid as evidence accumulates that the current configuration of debt, valuations, and interconnected financial relationships has become substantially more precarious than commonly acknowledged. Consider the state of global debt, which has reached $315 trillion, representing more than 330% of global gross domestic product, according to the Institute of International Finance. This staggering figure encompasses governments that have accumulated record levels of debt relative to their economic output, corporations that have borrowed heavily at cheap rates only to face rising refinancing costs, as interest rates remain stubbornly higher than they were during the years of ultra-cheap borrowing, and households that continue to struggle with rising living expenses while their accumulated debt burdens grow at rates that outpace income expansion. The United States government exemplifies this dynamic with federal debt held by the public surpassing $31 trillion for the first time, exceeding the entire gross domestic product of the country, a milestone that had not occurred outside of World War II in modern history. The debt-to-GDP ratio has climbed to 122%, and the Penn-Wharton budget model estimates that under current fiscal trajectories, the United States can sustain a maximum debt-to-GDP ratio of approximately 210%, suggesting that the country has already consumed roughly 60% of its fiscal capacity before reaching an outer bound of sustainability. Interest payments on federal debt have exceeded $1 trillion annually, approaching one-fifth of all federal revenues, and the Congressional Budget Office projects that net interest payments will grow to $1.8 trillion by 2035, representing a 76% increase from current levels, making interest payments consume an ever larger share of the budget at the expense of investments in infrastructure, defense, and social programs. The Federal Reserve reported at the end of the first quarter of 2025 that total household debt reached $18.2 trillion with serious delinquencies, defined as debts that are 90 or more days past due, reaching 2.8% of total debt, a 52% increase compared to the first quarter of 2024. Student loan delinquencies surged dramatically as past due reporting on student loans resumed after nearly 5 years of pandemic-related pauses, rising from 0.53% to 7.74%, reaching the highest level of student loan delinquencies since the start of the pandemic and indicating that nearly 8% of all outstanding student loan debt was delinquent or in default. Credit card delinquency rates have increased, reaching levels above the pre-pandemic average, and the average auto loan payment has risen nearly 30% between 2020 and 2023 due to higher vehicle prices and elevated interest rates, creating payment pressures that are disproportionately affecting lower-income households, with the highest rates of new auto loan delinquencies concentrated among the lowest-income consumers. New mortgage delinquencies are also rising, with the delinquency rate for mortgages increasing as housing affordability has reached historic lows, and the ability of households to extract equity from their homes has become more constrained, with home equity line of credit balances rising, yet overall home appreciation pressures moderating in many markets. The commercial real estate sector faces unprecedented stress, with approximately $957 billion in loans maturing in 2025, nearly triple the historical 20-year average, creating what industry observers call a maturity wall that presents extraordinary refinancing challenges during a period of elevated interest rates and reduced lender appetite. Office vacancy rates have reached nearly 20% at the national level, with some major markets like San Francisco experiencing vacancy rates exceeding 22%, reflecting the structural shift in workplace arrangements driven by hybrid work adoption that has reduced demand for office space to 30% below pre-pandemic levels. The delinquency rate on commercial mortgage-backed securities for office properties reached 7.29%, with commercial mortgage-backed security office delinquency rates climbing to 11.1% by the end of 2024, the highest level on record, indicating severe stress in a sector that had previously generated stable cash flows and reliable returns for institutional investors. Perhaps no sector has attracted as much attention and speculation as artificial intelligence, with technology companies and AI developers spending $750 billion on data center construction during 2024 and 2025, and planning to spend an additional $3 trillion through 2029 on what they expect will become the infrastructure supporting the next generation of technological transformation and economic productivity. This capital expenditure wave mirrors in many ways the construction binge of the late 1990s, when telecommunications companies spent over $500 billion to install more than 80 million miles of fiber optic cable networks in anticipation of explosive demand for bandwidth that never arrived at the expected scale or velocity, creating a financial crisis that decimated investor wealth and took years to resolve. The current AI capital spending cycle has been financed partly through traditional corporate earnings, but increasingly through aggressive debt issuance and complex off-balance sheet financing structures that distribute risk across special purpose vehicles, infrastructure funds, private credit providers, insurance company balance sheets, and data center real estate investment trust ETFs. Companies have issued $1.2 trillion in investment-grade bonds to fund AI infrastructure, and are receiving massive loans from private credit providers whose activities fall outside the traditional banking regulatory framework, and whose behavior during market dislocations remains largely unknowable. Venture capitalists and private equity investors continue to place bets using a traditional power law model, hoping that 1 in 10 investments delivers 100 times returns. Yet the economics of AI infrastructure face fundamental challenges, with the AI industry needing to generate approximately $650 billion annually to achieve just a modest 10% return on current capital expenditures, while actual revenue run rates remain significantly lower at approximately $25 billion. OpenAI. The most prominent AI company has made approximately $1 trillion in financial commitments to purchase advanced chips and acquire data centers, yet generates only $13 billion in annual revenues, and reportedly incurred a net loss of $8 billion during the first half of 2025, with projections that the company will not achieve profitability until 2030. Circular financing arrangements between major technology companies have raised concerns among market observers, with NVIDIA investing $100 billion into OpenAI, which then uses that capital to purchase NVIDIA chips and partner with Microsoft, which is simultaneously a major customer of NVIDIA, creating interdependencies and potential contagion risks that could rapidly unwind if any component of this complex web experiences financial distress. The economist Geeta Gopinath, former chief economist of the International Monetary Fund, has warned that a bursting of the AI bubble on the magnitude of the dot-com bubble collapse in 2000 could have severe global consequences, including the wipeout of more than $20 trillion in wealth for American households and $15 trillion in wealth for foreign investors, representing a devastating loss of purchasing power and financial security for millions of families globally. Imagine a middle-class family living in suburban America with stable employment, owning a home, and maintaining retirement accounts while believing their financial future is secure. Every month, they make mortgage payments, contribute to savings, and watch the stock market climb higher with the assumption that tomorrow will resemble today. Yet this family's financial stability now depends on multiple systems that are themselves destabilizing and becoming increasingly difficult to sustain. Their retirement accounts are heavily invested in the same mega-cap technology stocks that represent the overwhelming majority of stock market gains, and carry valuations that are stretched to levels not seen since the dot-com bubble, with the S&P 500 trading at 23 times forward earnings evaluation multiple that has historically preceded significant market corrections. Their home's value, which had become their primary store of wealth, has stopped appreciating in many markets, while property taxes remain elevated, and the physical condition of aging housing stock requires increasing maintenance expenditures. Their job security, although it appears stable, exists in a macroeconomic environment where corporations are simultaneously laying off tens of thousands of workers while spending hundreds of billions on data centers, creating an internal contradiction between short-term cost-cutting and long-term capital investment that may eventually tip toward further employment disruptions. Their mortgage payments remain at elevated levels, locked in at the higher interest rates of recent years, while alternative investments offer unprecedented returns, creating an incentive to refinance, yet most homeowners face the prospect of substantially higher payments, or the reality that refinancing is no longer an economically viable option compared to holding their current mortgages. The family's credit card balances have accumulated as they try to maintain consumption patterns while facing inflation that continues to compress purchasing power and reduce discretionary income, leaving them increasingly reliant on credit to smooth consumption over time. This family is now experiencing the same psychological and financial pressures that preceded the financial crisis of 2008, but with some significant differences. Financial regulations have improved since 2008, and traditional banks are better capitalized than they were before the crisis, with higher capital requirements mandated by regulators responding to the lessons of the previous catastrophe. Yet risks have not disappeared, they have merely relocated and mutated into forms that are less visible and less well understood. The shadow banking system has expanded dramatically with non-bank financial institutions, including private credit funds, hedge funds, insurance company investment divisions, and pension funds engaging in increasingly complex financing arrangements that fall largely outside the traditional regulatory framework. The Federal Reserve's balance sheet operations, which provided liquidity during previous crises, have now shifted into reverse with the Fed offloading bonds, while simultaneously the federal government is running the largest budget deficits since World War II, forcing the government to borrow heavily at precisely the moment when the Fed is withdrawing liquidity from financial markets. Geopolitical tensions have escalated significantly with tariff disputes between the United States and China, reaching a peak of 145% tariffs on Chinese goods entering the United States and 125% tariff on U.S. imports to China, before moderating somewhat following a trade truce that remains fragile and could easily collapse. The tariff escalation has created extraordinary volatility in financial markets, with single-day moves that rival some of the largest market swings in history when the S&P 500 surged 9.5% on April 9, 2025, in response to a 90-day tariff pause, only to decline 4.6% the following day, as concerns over escalating trade tensions reasserted themselves. Global trade flows have been disrupted, with direct trade between the United States and China potentially collapsing, while supply chains that depend on seamless movement of goods across borders face reconfiguration away from efficiency and towards security, creating permanent inefficiencies and higher costs that will be reflected in consumer prices. The combination of these factors creates a systemic vulnerability that operates through multiple transmission mechanisms, with failures in any one area potentially triggering cascading problems throughout the interconnected financial system. If the AI bubble bursts and technology stock valuations contract sharply, pension funds, insurance companies, and investment portfolios heavily weighted toward these holdings would experience substantial losses, reducing wealth and purchasing power. If commercial real estate defaults accelerate, banks with concentrated exposures to office properties would face impairment to their capital bases, and potential solvency pressures, particularly regional and smaller institutions that often have higher concentrations of real estate lending. If household delinquencies continue rising, bankruptcy filing would increase, credit card charge-offs would accelerate, and consumer spending, which represents more than 2/3 of economic activity, would decline, producing a negative multiplier effect throughout the economy. If government debt dynamics become unstable and investors lose confidence in the ability of the government to service its obligations, interest rates would spike, creating a destructive feedback loop where higher rates increase borrowing costs, which increase debt service, which further undermines confidence. The derivatives market, with a notional value estimated at over $600 trillion globally by the Bank for International Settlements, contains the seeds of systemic contagion, with counterparty relationships and bilateral credit exposures that remain opaque even to regulators and could amplify any initial shock into a market-wide deleveraging spiral. Shadow banking activities continue expanding outside traditional regulatory frameworks, creating blind spots for policymakers and creating conditions where financial stress can develop and propagate without adequate visibility or capacity for intervention before problems become severe. The concentration of market value in the top 10 stocks on the S&P 500, which are predominantly AI-related companies, creates vulnerability to a sharp repricing if expectations about artificial intelligence, profitability, and adoption prove more modest than current market prices reflect. The government's capacity to respond to the next financial crisis with the kind of massive stimulus that was deployed during the 2008 financial crisis and the COVID-19 pandemic is substantially constrained by already elevated debt levels and the reality that further debt finance stimulus would exacerbate the underlying fiscal position, making each successive crisis response more challenging and less effective. Does this mean another financial crisis is inevitable and imminent? The honest answer is that no one can predict with certainty the exact timing of when financial fragility tips over into actual crisis, but the probability has increased substantially, and the conditions for a crisis are demonstrably present and accumulating. Rather than waiting for the precise moment when stress becomes apparent, economists and investors are beginning to price an elevated risk with the VIX index, which measures implied market volatility, climbing back to levels not seen since 2023 and reflecting heightened nervousness about the fragility of current conditions. The J.P. Morgan Outlook estimates a 40% probability that the U.S. and global economy will enter a recession by the end of 2025, up substantially from prior expectations. as emerging data on consumption, employment, and business investment suggest that economic momentum is slowing faster than previously anticipated. Rather than waiting for a crisis to reveal itself, it would be rational for individuals, households, and businesses to begin now implementing strategies that build resilience, increase flexibility, and reduce exposure to the specific sectors, industries, and markets that appear most vulnerable. Financial resilience begins with understanding that diversification remains the most reliable strategy for managing risk without needing to predict the timing and mechanism of market dislocations. Diversification across asset classes, geographic regions, and security types reduces the probability that any single adverse development will devastate a portfolio. Emergency savings accumulated in cash or liquid equivalents provides a buffer that allows individuals to weather income disruption, employment loss, or unexpected expenses without being forced to sell assets at the worst possible time during market dislocations. Manageable debt levels ensure that even if income declines or employment is disrupted, the obligations that must be paid each month remain within the capacity to service them even with reduced income. Long-term planning and regular rebalancing of portfolios ensures that concentrated positions that emerge from market movements are trimmed and proceeds are deployed to areas that offer more attractive valuations and lower risk. Understanding the current state of the financial system and the mechanisms through which problems propagate is the necessary foundation for these practical steps. The history of financial crises demonstrates that they rarely begin with a single dramatic event, but rather develop gradually as debt accumulates, risks build quietly, and confidence gradually weakens before reaching a tipping point beyond which the system experiences rapid repricing and adjustment. Before the financial crisis of 2008, housing prices rose rapidly while lending standards, weakened credit rating agencies, failed to accurately assess risk, and financial institutions became increasingly leveraged on the assumption that housing prices would continue to rise indefinitely. Before the dot-com crash of 2000 to 2002, investors believed that internet companies could only become more valuable regardless of their actual business economics and poured capital into companies with no clear path to profitability on the assumption that getting big fast would eventually produce profits. In each case, the underlying economy contained genuine opportunities and technological innovation created genuine possibilities for transformation, yet expectations eventually became disconnected from financial reality. And when confidence weakened, the adjustment occurred with surprising speed and substantial losses for those caught holding overvalued assets. The current financial environment contains both real innovations in artificial intelligence and genuine long-term productivity opportunities, alongside a financial structure built to support spending levels that may not arrive and whose economics may deteriorate if demand does arrive at expected scales. The greatest financial advantage is not predicting the future perfectly or timing market moves with precision, but rather being prepared for whatever the future brings. By building resilience through the boring but effective methods of diversification, emergency savings, manageable debt, and long-term planning. Whether another financial crisis arrives in 2025, 2026, or is postponed for several more years, history suggests that economic booms and downturns are both natural parts of the financial system, and that the question is not only whether another crisis will come, but whether individuals, businesses, and governments will be better prepared when it does arrive.